Subscribe to Shiksha Online and click on the bell icon for more updates.
Hello students, welcome to this video lecture. In today's video session, we will be studying CVP analysis and we are covering the following topics in this chapter. So let's start. First topic we will be studying is introduction. Then second one is meaning and cost volume profit analysis. Then we will be studying application of CVP analysis. And then our next topic is break even chart, and after that we will be studying how to prepare profit volume graph, and our last topic will be advantage and limitation of break even analysis. So now let's start with our first topic, that is introduction. So before explaining the concept of CVP analysis, I'll give you the practical example so that you can understand what exactly CVP analysis is and why we calculate CVP analysis. Basically, CVP analysis is calculated if you want to know how much sale is required to cover your fixed cost or variable cost in business, or you want to know how much sale is required to earn profit of rupees 1 lakh, or you want to know like how much profit is increased if there is reduction in variable or fixed cost by 5% or maybe 10%. So all you this calculate only by doing CVP analysis. This is very much useful, like if you are running any kind of business, then this will be very useful for you. So now let's move to our next topic, that is meaning of cost volume profit analysis. Now let's understand the meaning of CVP analysis with the help of one example. Let's suppose we started business of computer shop wherein we sell all categories of computer or laptops. The selling price of one laptop is rupees 50,000, variable cost per unit is rupees 40,000 and total fixed cost rupees 10 lakh per month, that is rent for a shop. Then how many units are required to be sold per month to cover only fixed cost? This we can calculate only with the help of CVP analysis. Now you can see the table on the screen where sale per unit of one laptop is 50,000 and variable cost per unit is 40,000 and contribution we get after deducting variable cost from sales is rupees 10,000. You can see this in screen. Break even point we will calculate. We have one formula, that is total fixed cost divided by contribution per unit. Here total fixed cost you can see rupees 10 lakh which we are paying rent of a shop, and contribution we have calculated, you can see in screen, rupees 10,000. If we divide total fixed cost by contribution per unit, then we get answer 100 units. It means if we sell 100 units per month, then we can cover only fixed cost. There will be no profit if we sell only 100 units per month. Now suppose we want to earn profit of rupees 1 lakh per month, then how many units are required to be sold? For this we will use formula, you can see on screen. Number of units is equal to fixed cost plus desired profit divided by contribution per unit. Fixed cost is rupees 10 lakh, desired profit which we are looking for rupees 1 lakh, contribution we have already calculated previously rupees 10,000. So we get answer 110 units. As the name suggests, CVP analysis means analysis of three factors, that is cost, volume and profit. So let's understand one by one. First of all, we will understand what is fixed cost. Fixed cost means which is not changed with the change in output. Even if I produce 1 unit, then I have to pay the rent. Even if I produce 10,000 units, then I have to pay the rent. The amount of rent will remain the same. So fixed cost is the cost which does not change with the change in the level of output. For example, rent, insurance, all these expenses are called as fixed cost. Now we move to our next cost, that is variable cost. Variable cost means which change with the change in the level of output. If I produce 1 units, then cost of raw material and cost of labor will be incurred accordingly. But if I produce 1000 units, then this cost will change significantly, because cost of producing 1 unit and cost of producing 1000 units may be changed due to change in the level of output. So we can say variable cost means, for example, cost of direct material, cost of direct labor. So now let's understand how to prepare graph of fixed cost and variable cost. As you can see on screen, the amount of fixed cost is same. You can see the fixed cost line which is constant and not changing with the change in the level of output. Even if we do not produce any unit, then fixed cost will remain same. But the variable cost line is increasing with the increase in level of output. You can see variable cost line on screen. The variable cost will be 0 in case of no production. This is also represented in the given diagram. So now let's move to our next topic, that is application of cost volume analysis.